Warren Buffett may be retiring, but he's had one huge last win. The Bank of Japan is selling one of the world's largest ETF portfolios. We're unpacking all the ways that you can boost your superannuation as part of Super September. And Sam Gordon is joining us to show us all the ways in which you can get into the property market on any budget. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to our community. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. How could I not be after that little tease at the top of the show?
Yeah.
There is a lot happening in markets. We're going to be unpacking it all. Let's get into the news.
News and markets.
Ren, headlines we're unpacking today. Warren Buffett has absolutely done it again, and the Bank of Japan is selling one of the largest ETF portfolios. Their capital gains are incredible.
Yes, yeah. Well, let's start with Warren Buffett. Now, for people unfamiliar or new to investing, Warren Buffett is the greatest investor in history, arguably.
Definitely.
He is the chairman of Berkshire Hathaway. He took over Berkshire as a failing textile mill in 1965, and over the following 60 years, gained more than 5 million % returns, turning $1,000 into $5 million or there or thereabouts. An incredible story and a real icon that sort of is the counterpoint to the hard-charging, fast-talking, modern financial stereotype.
Yeah.
He's a slow-talking old man who lives in his family home and finds great long-term investments. And that's why we love him, and that's why we talk about him a lot. But the other reason we love him is he makes pretty good investments.
He does, and he's absolutely done it again with an investment that they made back in 2008 in BYD, the Build Your Dreams Chinese EV car manufacturer.
Yeah, so in 2008, Berkshire Hathaway invested $230 million. That got them 9.89% of the company. After watching that investment rise to $9 billion from $230 million, by 2022, Berkshire started selling. And the news and the reason we're talking about it today is Berkshire has now completely sold out of BYD. So despite Chinese EVs really having a moment, Buffett has decided it's time to get out. Now, first of all, let's give him his flowers. $230 million to $9 billion is a 39 bagger. That's up 3,813%. So that's where the credit is due. Ironically, though, if he had held, today their stake would be $13.55 billion. It would be a 59 bagger. A reminder that when you find a winner, let it
run. Now, we should also mention, Ren, that we've spoken a lot about Buffett, but it was actually Charlie who was the instigator of this deal, who championed this deal and brought it to Buffett. Unfortunately, Charlie is no longer with us. And again, for those unaware, Charlie was Buffett's longtime partner, business partner. So full credit. So
I wanted to see how BYD was, and this investment was discussed in 2008, because I think a trap that we can fall into as investors is it was obvious in hindsight trap. And the challenge for investors is we look back and say, oh, Apple or Microsoft, how it looks today, that's what we need to be looking for as investors. But the challenge is we obviously don't have hindsight when you're making investment decisions. And so we need to think about what the investment looked at the time the winning investment was made rather than what it looked like 20 years later in hindsight. And so I had a look at how this investment was reported in 2008. I found a New York Times article. Headline, Buffett buys stake in Chinese battery manufacturer. So even there, it wasn't a car maker there.
Yeah.
So from the article, BYD is one of the world's largest makers of rechargeable batteries for cell phones and other uses. The company also has a fast-growing automaking unit that accounts for nearly a third of its revenue. So even in those couple of sentences, you can see it had a large established business, and Berkshire actually made the investment through its energy utilities company. And so it spoke about, seeing opportunities to do like grid scale batteries and store renewable energies. But you could see that there was this other business unit that was fast growing. And this is the thing that stood out for me. Quote from the New York Times. Mr. Buffett did not attend the news conference, but said in a statement that he was impressed with Mr. Wang's record as a manager. And that is the story over and over again when it comes to investing. The story of Berkshire is finding great people and trusting that they will build their businesses over time. And this is another example of that. The BYD that we know today isn't the BYD that Berkshire invested in 2008, but it was a good manager who had a good track record of building businesses. And there was this sort of nascent, fast-growing small business that they saw a big opportunity in. And so I think there's a number of lessons we can pull out there when we're looking for companies that have some of those hallmarks.
Yeah. I mean, to put some numbers to it, at the time, BYD's revenue was, I think, 1.3 billion in 2008. 2025, it's about 176 billion Australian.
Yeah, okay.
So incredible growth.
Yeah, and
backing the manager to get it done.
Yeah.
Go Buffett.
Go Buffett.
He's done it again.
Yeah, an incredible story. He's 95 years old. He's said he's going to be retiring at the end of the year. So every opportunity we get to celebrate a Buffett win, we should take it.
Absolutely. So, Ren, I want to bring to the table, Buffett has obviously been an incredible long-term investor, but so have the Bank of Japan.
Okay.
This is a news article that caught my attention. So the Bank of Japan are selling down their enormous ETF positions. So they have currently $537 billion worth of ETFs sitting on their balance sheet.
US dollars?
US dollars, yeah. And the bank is trying to sell them down to what they say normalize their monetary policy settings. So let's take a step back and unpack what that actually means. So back in 2010, the Bank of Japan started buying ETFs. It was due to factors that were going on in the economy at the time, and they really wanted to loosen their monetary policy. They were battling deflation, and they needed to boost asset prices. Essentially, the economy and the market was in the toilet. Or had been for a very long period of time.
Yeah. No, so they were battling deflation. They'd cut rates as much as they could to try and stimulate the economy. And then this quantitative easing is another way to try and boost asset prices and push money into the economy. What we see from like the US Federal Reserve, what we see from the RBA in Australia is they'll buy bonds.
Yeah.
And they'll buy bonds and that will push more liquidity into that market. And then hopefully other participants in that market then use that money to go and do other things. The Bank of Japan had bought all the bonds they could, and so then they turned to ETFs.
Yeah, they couldn't buy any more bonds.
Yeah.
So they started buying up big. Over the last 15 years, they have now become the single largest investor in the Japanese stock market, accounting for about 7% of the Tokyo Stock Exchange, and they are the top shareholder in over 50% of companies listed on the Japanese index, the Nikkei 225. However, good news, inflation is now back, currently 2.7%. And so the Bank of Japan is saying we need to start unwinding this and getting our monetary policy settings back to a more normal setting. So
I think we should just pause here because you had the percentage of the total Tokyo Stock Exchange, 7% of the total stock exchange. But in terms of the Japanese ETF market, the Bank of Japan owned almost 80% of ETF units issued in Japan.
Unbelievable. Yeah. So they have to start unwinding that. Now, you can imagine when they come out and say we need to start unwinding 80% of the ETF market and 537 billion, it will scare the market a little because if they do that incredibly quickly, there's going to be a lot of downward pressure on the stock price. So what have they said? They're going to be doing it over a very long period of time. In fact, the head of the bank said they expect it to take more than 100 years to unwind almost $500 billion, essentially doing $4.2 billion a year in sales, equivalent to 0.05% of daily trading. They don't want to mess with the market, but they need to unwind it. So this is going to take a very, very long period of time. I mean, they got to do it. And I think if you look at their capital gains on that, 537 billion, almost half of that is capital gains.
Yeah.
So good long-term investing.
Well, I think that's my big takeaway here. It's like even when a central bank was doing this to try and stimulate an economy that was struggling, the power of dollar cost averaging into index ETFs is undisputable here.
Yeah.
Because from 2010 to 2025, so a 15-year buying program, it saw them double their investment.
Yeah.
537 billion value today with unrealized gains of 296 billion. So they more than doubled their money in 15 years, despite all of the economic struggles in Japan.
Index investing. Index investing.
Well, whatever ETFs they were buying.
No stock picking.
If that is not a case for consistent, regular investing, then I don't know what is.
I know. Our mission to engage Australians with their superannuation continues, Ren, with Super September. We only have a couple of episodes to go. So let's get stuck into today's focus, which is to find ways to boost your superannuation.
That's right. We're talking about how the government can help boost your super. We're talking about how your partner can help boost your super. We're also going to talk about how we can
all the ways.
What's the saying? God helps those who help themselves.
Yep.
We're not a religious podcast here, but we'll take their saying. We're going to talk about how you can boost your super, and we're doing it in partnership with our partners here for this year's Super September, Vanguard Super.
Yes, Vanguard's super lifestyle option is designed to take the stress out of superannuation. It automatically adjusts your investment mix as you age, focusing on growth while you're younger and gradually reducing risk as you approach retirement, all without you lifting a finger.
Check out Vanguard Super at vanguard.com.au/super.
Products issued by Vanguard Super Proprietary Limited. Consider the PDS and MD at vanguard.com.au/super and decide if it's right for you.
Now, a big thank you to Vanguard Super for helping us keep all of our content free here at Equity Mates.
Yeah.
And it's important that we keep our content free here at Equity Mates, Bryce, because too many Australians are not engaging with their super. We started this whole Super September this year by talking about the stat that 40% of Australians hadn't logged into their superannuation in the past 12 months.
Yeah.
And if you're not logging in, you're not engaging with your super, then you can't be sure it's optimized. But what you also can't do is take advantage of all of the ways that the government is trying to boost your super.
There are a lot.
The government is trying to put money in your pocket. And if you're not taking it, then I don't know why you listen to an investing podcast. But what we want to do today is unpack some of the key ways that you can boost your super account.
Yeah, so let's start with just a quick reminder how we can help ourselves. Because as you said, there are plenty of ways that the government sets up superannuation. So we spoke about voluntary contributions earlier in the week. A reminder, you have a concessional cap, which is now $30,000 a year, where you can put in concessional contributions up to that amount.
And what that means is it's taxed at 15% rather than your marginal tax rate, which might be 30%, might be 37%, might be 47% with the Medicare levy. Yeah. So like you could be saving 30 cents on the dollar by using the concessional cap.
Huge. Now, if you haven't done that, the good news is you then have what are called carry forward concessional contributions. You can maximize the last 5 years that haven't been used and bring that forward and do it in one lump sum. That's the concessional. If you want to put in more, you can do non-concessional contributions up to $120,000 a year. The beauty of doing it that way is that once the money is in superannuation, the income on that is taxed at the 15% tax rate in super. So you can really help yourself by doing voluntary and then non-concessional up to 120 if you really just want to get money in there working.
So that's the first way, how you can help yourself. The second bucket is how the government can help. And this is over and above the tax advantage they give super. There are a number of programs that people should be aware of. They all have specific terms and conditions, which we'll talk to, but there are a number of ways that the government try and boost your super beyond the tax benefits.
Yeah. So the first one is the Super Co-Contribution Scheme. This is where it supports people on lower incomes. So if your annual income is below a threshold and personal after-tax contributions are made, then the government adds up to $500 to your super fund.
Yeah, now it's not quite like a one-to-one matching, but the maximum co-contribution from the government of $500 a year comes when you contribute $1,000 and you earn less than $42,016. This co-contribution scheme in some way, shape or form is available to those earning up to $57,016 in the last financial year.
Yeah.
So obviously these numbers move year on year, but the point here is that if you're a low income earner, that the government literally want to match your contributions. Well, literally want to add to your contribution.
Yes, give you more.
So they're literally putting money in your super account.
Yeah, well.
So that's putting money in.
Yeah.
The other way is they want to give you a tax rebate.
Yeah, they want to give you money back. So this is the low income superannuation tax offset. So it's for people earning up to $37,000. If you put in a concessional contribution into your super fund, they will refund you up to $500 of the 15% tax paid on whatever amount that contribution is.
Up to the $500 tax. Yeah, let's be clear about that. And then essentially for that portion of the concessional contribution, it takes the 15% tax rate and makes it 0%. This one is easy. There's no need to apply. If you're eligible, the offset is automatically done. But it's worth keeping in mind that it exists. Now, a third way that the government wants to help is they want to help retirees top up their super. They also want to solve the spare bedroom problem in Australia, which is that retirees often have more house than they need.
Yeah.
And so they have introduced the downsizer contributions. This started in 2025, so it's pretty new. Australians aged 55 and over can contribute up to $300,000 per person, so $600,000 for a couple, from the sale of their home to superannuation, and that doesn't count to your concessional cap.
Crazy. Think about the tax here, the flow of this. You're probably likely to sell that house capital gains free.
Yeah, if it's
because you've held it for
it's like your family home,
years,
the kids have lived in there, the kids have left home, and you've got too many bedrooms now. So you sell, you've made a shitload of money on that house because it's an Australian house.
Fully capital gains free. You're in a couple, so you can then take 600,000 of that and just plonk it into super outside of your normal contribution.
Yeah, and then that 600,000 sits in the tax advantaged environment of super, earnings being taxed at 15% rather than your marginal tax rate.
If you're age 55 plus, it's not going to be soon until it's earning 0% tax because you're going to be then relying on it.
Yes. So look. Anyway, we're just here to talk about the policy. So be aware that if you're an older Australian, particularly if you've got parents who are starting to think about retirement, starting to think about selling the family home, this downsizer contribution has been introduced. It's just another way that the government is trying to help you help yourself and boost your superannuation.
Yeah.
So there are 3 policies to be aware of. The third bucket that we wanted to talk about was how your partner can help.
Yeah, so this is a good one. It's the super contribution splitting. So it allows splitting of up to 85% of concessional, that's before tax, contributions with your spouse. Then there's spousal contributions where you can contribute up to $3,000 per year to your lower earning spouse's super. Now, your spouse must be earning less than $40,000 and they don't need to be working. So it's great for those that are on paternity leave, for example, or don't find themselves in a position where they're unable to be working for a period of time.
Yeah, and so for those spousal contributions, they can earn a tax offset of up to $540. So it is capped.
Yeah.
I think the important thing, these 2 policies, I often get confused about the difference between them. So super contribution splitting and spousal contributions, both ways that I guess a higher earning spouse can support a lower earning spouse. The important distinction is super contribution splitting is splitting the already in your super concessional contributions. And by splitting it with your spouse, it doesn't count to their concessional contribution cap. So it's a way for them to catch up if they're sort of behind with their super. Spousal contributions are when you're putting additional money into super.
Yeah.
And they do count towards your spouse's non-concessional cap. Yeah. But obviously, if your spouse isn't working or is working part-time and is earning less, then they're probably a fair way off their concessional contribution cap.
Big time. Now, we just want to close out with some good news for the paid parental leave because super is coming in 2026
I think the headline here is we've spoken about the ways the government is trying to help. The reason you got to keep engaging with your super is the government's putting more and more policies to try and help us more.
Yeah, I love this one. From July 2026, government-funded paid parental leave will include superannuation payments, which we know is going to go a long way to addressing these super gaps that really impact people that take time out of work later on down the track. So keep an eye on that one. But Ren, there you go. 3 key ways that you can add more to your super and engage with your super, log in and just figure out all the ways that the government are pleading to put money in your pocket.
Yeah. The government recognised that super has been a big success. but it is so important to fund people's retirements, and they are doing everything they can to get us to engage with our super.
Yeah.
Everything but coming and sponsoring Super September. So thank you to Vanguard Super for stepping up where the government hasn't. But I think, this is why it's so important to engage with, because there's so many opportunities to boost your super, to make it work hard for you. And then, once you get in the weeds and optimize the investments to make sure it is working as hard as you're working, it can really set you up for a great retirement. That's why we do Super September. We've got one more segment where we're going to recap everything that we've covered throughout Super September. So keep your ears and eyes peeled for that. But over the weekend, log into your super at the very least.
At the very least. All right, we're going to take a quick break, and on the other side, we will be joined. Well, in fact, I will be joined by Sam Gordon. At the time of recording, Ren, you are actually on holidays. So Sam's going to join me to discuss what's going on around Australia in the world of property and how anyone can get into the market on any budget. We'll be right back. We're here with Sam Gordon, our resident property expert, the founder of Australian Property Scout, host of Scouting Australia podcast, and the Top 1%. Sam, welcome back.
Bryce, thanks for having me, mate. Great to be back.
Now, if you've just joined us for the first time, Australian Property Scout is Australia's leading investment buyer's agent, and Sam works with plenty of the Equity Mates community. So if you're interested in working with Sam, we'll put a link into the show notes for you to get in touch. But Sam, as always in these segments, we come to you for an update on what has been going on in the world of property. We've seen recently the Aussie government has brought forward their first home buyers scheme, allowing 5% deposits. So I think it's time that we get an update on what has been happening in property around Australia. So where do you want to start?
For sure, bro. I mean, even touching on that to start, man, firstly, thanks for the welcome, mate. Always good to be back and talking with the Equity Mates listeners. But yeah, man, the government bringing that forward is going to be a really interesting thing to watch play out leading into the rest of the year, combined with, we've already had 3 rate cuts. We're potentially going to see another one heading into the end of the year, and obviously potentially aggressively into next year as well. But when you throw that into the mix, alongside bringing forward, by a full quarter, this, the new grants in government backing that they're doing, the deposit scheme. It's going to be really interesting to see how that plays out, specifically in the bottom end of the market and with a lot of capital cities. So it's going to be interesting to watch play out. We're still in a massive stock deficit in most locations. Build prices are still at all-time highs and only increasing. So it's just creating more and more of a demand, and obviously population growth still quite strong as well. So it's all the things still pointing towards a continued sort of storm, and this thing could create more of even of a perfect storm as well. Because one quick thing to note on this is whenever the government gets involved with policies when it comes to the housing market, it almost always causes a boom. And yeah, man, I don't think this is going to be any different from before.
Yeah, I mean, we'll get into some of the numbers in a moment, but I remember when I was trying to buy our place in 2023 and in here in Sydney or New South Wales, it was at the point where the government were allowing first home buyers to choose between land tax or stamp duty.
Interesting.
And the cutoff was a home value of 1.5. And so what it was doing was allowing people to choose to not pay stamp duty up to 1.5. Yep. And so there was this crazy bottleneck at 1.5 because people were just bidding up to it because they knew they'd save 90 grand on stamp duty. And so now you see here in New South Wales, or for Sydney particularly, this 5% scheme, they've increased the cap from 900 to 1.5. Other capital cities, it's not as much, but I think Melbourne's now 900 or whatever. Like, it's only going to lead to one thing, which is people bidding up to these caps. Yeah, it's just not. It's wild.
100%, man, and it happens every time they look at the same time with when you bought yours as well. Man, it always plays. It always plays out in this sort of way. And if anything, it actually potentially creates a bit of value in that market that's slightly above it. So again, like even though it might be stretching to get above it, a lot of people might end up paying an extra $200,000 for a property worth 1.3, but pay 1.5 to save themselves 90 grand on stamps. You might be able to buy quite a good asset that's potentially $300,000 better at 1.6 mil. You might pay the stamp duty, but are you actually saving $100,000? In terms of what the property's worth, comparatively to the lower amount. And it'll just be an interesting thing to watch play out. But almost always it creates that, exactly like you say, that bottleneck at that different price point. And it's almost an exciting thing if you own property in a capital city that's now at an inflated figure of that has the ability to move up to, because undoubtedly we're going to see growth to those price points.
Yeah. Now we're going to speak a little bit about rent vesting and revisit that topic for those that have just joined the show and looking to get into the property market, but perhaps priced out of their first home. But before we do, what are the key numbers from around Australia?
Yeah, man. So running through the stats, I know you boys always love to run through the stats. It's been an interesting sort of one, watching it play out. I've taken a screenshot of my phone rather than all the notes I normally do because I couldn't fit it in. I need to compress it, man, because there's a lot of things to break down, not only in the housing market. I think that's something to quite interesting to sort of unpack from that front too. But if we look at throw the major capitals in there. Sydney over the quarter was up 1.9%, annually up 2.2%. That's interesting to actually even unpack that in itself, because over the quarter, almost the same as a year, meaning the quarter has more velocity behind it than the annual.
Yeah.
And that's why it's always quite interesting to sort of watch these numbers and how they're sitting. And again, even for the month, 0.8%. So again, if you annualize each of these amounts, it's showing potentially a bit of momentum in that market too. So Melbourne, similarly, very much the same, 1.5% over the quarter, but only 1% annually.
Wow.
So it's got more, significantly more over a quarter than even produced annually. So again, we're seeing movement from that quarterly rate. Brizzy up 2.1% over the quarter, 6.7% over the year, so still in market growth. Adelaide 1.4% over the quarter, 6.8% annually. Perth 2.6% over the quarter, 6% annually. So again, we're still seeing that consistent growth rate. And while they're not crazy, if you annualize Perth at 2.6% over the quarter, it's still 10% plus, double-digit growth. Yeah. So still quite a decent rate of growth. Throw Canberra in the mix as well, obviously being quite an expensive location too. 1.9% over the quarter. 0.8% over the year. So again, another capital that is showing good momentum and good growth. Not huge growth, but still showing it in the right direction at that point too. Now, that's for the housing market. What I thought was actually really interesting to unpack, and I think we discussed this last time when we discussed the numbers. I think it might have even been leading into this year as well. Other than Perth housing market in 2024, the three standout markets for growth, other than Perth housing market, was actually Perth, Brisbane, and Adelaide unit markets.
Really?
So they actually outperformed every other housing market in the country.
Wow.
And a huge piece of that and portion of that was obviously the affordability factor.
Yeah.
So we saw a massive uplift in rents over 23, 24 because of massive population growth, not building enough properties. But then because of the affordability factor and how much price growth we've seen in houses, we then saw that correlate back down to, significantly more affordable product being the unit market, seeing massive growth. So those three unit markets last year saw 20% plus growth.
Whoa.
Yeah, so pretty significant. And again, we're talking off air around like cash on cash returns.
Yeah.
Let's say you put $100,000 into a $500,000 investment, and it goes up. That $500,000 investment goes up by 20%. That's $100,000 in growth. That's 100% cash on cash.
Yeah.
So some pretty decent numbers getting thrown around in a few of these markets here, and some of them quite affordable too. And that isn't sort of slowing down too much from those three city perspectives. Brisbane up 3.2% over the quarter in the unit market, 10.8% annualized.
Wow.
2.1% over the quarter in Adelaide, 8.5% over the year for Adelaide as well in growth. And the Perth unit market, 2.7% over the quarter, 10.4% over the past year as well. So pretty sort of steady numbers quarter compared to annual, which is a bit of a disparity across the housing markets, showing the continued sort of demand for that lower end product, that cheaper price pointed product specifically in those three markets as well. They were the only ones that really showed any significant sort of growth from that. All the others in a unit market are flatlining. So very interesting to see most of the housing markets moving into a relative phase of growth or retaining that phase of growth considering the market.
Crazy.
And then some of those unit markets really popping off.
So nowhere has gone backwards.
For the housing market perspective, nowhere had gone backwards.
Well, there you go. That's the updates. So the question now is if you're looking to take advantage of these from an investor point of view.
Yes.
Now, when we got you on the show 18 months ago or thereabouts, we introduced you through the concept of rent vesting because that's very much how you started your journey. And I think to this point, you still don't own a principal place of residence. Is that correct?
That's changed.
Can I say that?
So 10 days ago, I settled on my
no
prime
way.
residence.
Congratulations.
So thanks, man. Thanks.
Well, finally, for the last however many years, you've been practicing what you preach.
For sure.
Which is just investing through property.
But I think it's a good bookend, right? And I think we'll get into the rent vesting in 1 second. But I think the cool thing is like for the first 8 years as an investor, so from I bought my first property at 19. From 19 to 27, I owned my own home. So 8 years in there. Then it was around about about 7 or 8, I think, depending on months and crossover and everything, somewhere between 7 and 8. And then again, around 7 or 8 years from there, I then rented where I wanted to live and save that considerable amount between not only the deposit and the equity that's tied up in your own home, but the actual cost difference between rent versus mortgage and all the other costs associated with owning your own home as well. And so I leveraged the benefit of that to then build a substantial property portfolio or build on my portfolio in a substantial way. And really, it's just a bookend to, 7, 8 years of going down that avenue of what most would call sort of a sacrifice piece of not owning my own home, to then being able to eventually buy the dream home. And this is the thing, I haven't just bought like a nice home. I've bought a very, very nice home, which was the point of the rent vesting for all those years, investing for all those years, and then also doing a sell down of quite a large amount of my portfolio to then be able to actually fund myself into a dream primary residence.
And I think that's something that I think it's worth a lot of people considering right now. It's like the median house price in Australia now, I think, has just ticked over $1 million. Yeah. And there's so much pressure on people to come out of university, save to buy their first principal place of residence. Sure. But there's definitely other ways that you can get into the property market. And your example there is one where you can get your dream home at some point in the future. Yep. So rent vesting is really the concept of renting where you want to live and then investing in property and servicing a loan, perhaps not at the crazy prices that you would need if you want your principal place, but investing in property to use that as a way of getting onto the ladder.
For sure.
So what do you think is the minimum realistic budget to start rent vesting in 2025?
One quick thing I'd probably throw in, just to tail end in on that note there as well, is a lot of people think there's security around owning your own home, and I don't agree with it, and it's because it's in a liquid asset, and so the government actually the banks don't look at it as an asset; they look at it as a liability.
Yeah,
it's a very expensive cost that's associated to you that you can't exit quickly, right?
Yeah.
So they don't look at it as an asset in your portfolio or an asset in general. And one of the other big things to note is that my honest belief is, actually, there's 2 points here. If you can't afford your dream home, then I don't think you should buy a home.
Yeah.
I don't think you should buy your own home. I think you should invest until you can afford to do it, until you can afford to buy your dream home, because the cost of bunny hopping each phase through buying a primary residence is very expensive. Stamp duty on the way into each deal, sales costs on the way out of each property, and just that transactional cost, especially an emotional purchase like that, it's very hard to get yourself well in front. And typically you get pre-approved for $1 million, $2 million. You go and spend that whole amount. You don't leave anything over to invest.
Yeah.
Rent vesting only works if you actually invest. So you can't, so a lot of people get hung up, they procrastinate, they don't buy. That is when you will kick yourself for not buying your own home.
You mean just renting?
Yeah, just exactly. It's just renting, right? It's just renting. So if you're going to do it, you got to do it. And so if you're not going to go down an actual rent vesting path, I agree that rent money is dead money. You should go buy your primary residence. But if you're willing to commit to it and actually build yourself a strategy, build a portfolio, create something significant, you're going to be in a much better position financially from rent vesting and going down that avenue versus buying your primary residence.
Yeah. So let's say someone is at that point. They're like, I can service a loan, but I'm not going to get my dream home. What do you reckon is the a realistic budget?
Budget in terms of minimum cash amount?
Well, more like, am I still looking to need to take out a mortgage of $1 million?
Definitely not.
Okay.
Never has been.
Okay.
It never has been, especially to invest. I mean, yes, it's a little bit dearer now than it was even, say, 12, 24, 36 months ago, where you could consistently buy properties to be realistic and probably to blow a lot of people's minds in the 200,000, 300,000s.
That does blow my mind, yes.
Yeah. And a lot of those properties now, again, we're talking off air around locations and timing markets correctly. A lot of those locations now, 250 grand properties now worth 500, 600K.
Yeah.
But there are still markets you can buy in the threes. There's still markets you buy in the fours. There's a lot of markets between, say, the $500,000 to $700,000 price point. So if you're borrowing between an 80 to 90% loan against that property as well, you're putting in 10 to 20% deposit. You might be taking out a $450,000, $500,000, $600,000 loan, something like that. But the cool thing is, at that price point, your rents are typically more reflective of your purchase price too. So instead of $1 million property renting for $600,000, $700,000, you might be buying a $600,000 property that might be renting for $500, $600 a week. So the shortfall is typically a lot less on these cheaper end properties, but your growth rates can be significantly higher as well.
So really, then, from a deposit point of view, you're not needing anything near what you would if you were looking for a principal place of residence.
No, definitely not. Definitely not. And really, the realistic budget of what you're talking about before, I mean, $500,000-$600,000 is quite, or $500,000 to $700,000 is a real sweet spot at the moment. And you might need, say, $100,000 to sort of get into your first deal to kind of kick things off right now.
And so when you're thinking about first-time investors doing this, do you think we should be focusing on cash properties, those that are giving a decent yield, or is it all about growth in the initial stages?
So initial stages is always growth. Unless you're a super low income earner and you can't afford something that's hugely negatively geared. Not that we ever want to play in the hugely negatively geared space. We always want to take cash flow into the equation, but when you're first starting out, you always want to focus on growth, because ultimately, if you've got $100,000 and that's all you've got, to put into a property, and let's say you keep a $10,000 buffer and you've got $100,000 to put into a deal, you need to replicate that as much as possible. So it's the same as we were talking about before. You buy a $500,000 property, and it goes up by 20% and gives you $100,000 back out. Let's say you borrow that at an 80 or 90% loan. You might be able to refinance 80 to 90 grand back out of it. There's another property.
Yeah.
Whereas if you were going for something else, I don't want something that costs me anything, so it's neutrally geared, but it's in Timbuktu and doesn't go up in value. Cool, it didn't cost you anything to own it, but how much did it actually cost you in growth?
Yeah.
There's something might have been 5-10 grand a year negative, it went up by 100,000. We're actually 90 to 95 grand in front of that cash flow asset. And so this is where people really need to understand, especially initially and building a portfolio, you need to focus on equity to continue to drive deposits, to continue to pick up assets, because the name of the game when you really want to build a portfolio is to build the asset base as big as possible, as quickly as possible, to allow it to have market exposure to really grow.
Yeah.
And then we can come back for cash flow further down the track.
And so then, just to kind of close it all out,
Yeah.
how does that strategy, where I'm just going to rent where I want to live,
Yep.
and go out and buy $400,000 or $500,000 property, and how does that then lead to me actually getting my dream home?
It kind of depends on what the definition of the dream home is. For some people it's 2 mil, some people it's 5, some people it's 15, right? But all the premise is always the same. You want to scale yourself an asset base large enough so that when that goes through X amount of growth, whether you build a 5 mil portfolio and it goes through 50% worth of growth, and you just netted 2.5 million, or 70, 75%, or 100% worth of growth, where we net somewhere between the 2.5, the 3.5, 5 million, whatever that is. If that's what your primary residence goal is, that's effectively how you can build it out and actually get there. So you build an asset base at X amount, it goes through, again, Y amount of growth, sell down, bank, and then buy it like that. Myself personally is I prefer to, and I like to build strategies for clients like this as well. I would prefer to build the asset base to build you a net passive income of a certain amount, whether it's 100, 150, 200, whatever the goal is. Start to build towards that. Come back for the primary residence down the track.
Yeah.
Because a $5 million primary residence probably rents for $2,000 a week. I know I just moved out of my rental and into the primary residence I just bought. The rental I lived in before was a $5 million primary residence, a $5 million home, and I was renting it for $2,000 a week.
Yeah.
So $100,000 a year versus owning that property with a $4 million worth of debt on it is probably about $300,000 a year, plus $1 million deposit plus stamp. So you're $1.5 million in to buy it at 80% plus $4 million loan. So instead, I would prefer to build out an actual passive income that can pay for that rent while I then continue to build out more of an equity base and let that continue to grow. And then when the time's right to exit those markets, sell them down, use the big deposits to actually pay for maybe 50% deposit on the home, and then use the passive income that we've just now built. Just now, we're talking 5, 8, 10 year window to do this whole play, to then fund the rest and pay the rest of that loan potentially out.
Yeah, nice.
So it's always a strategy dependent on what you're really chasing. But for me, what I've realized is the really expensive primary residences are typically really cheap to rent in comparison. So you build the passive income out first. That's going to allow you to live in that style of asset sooner, when then after that point, you can build out the actual strategy to build the equity base to own that property and buy it properly.
And I think the key thing here is just to remember that this strategy is one where if people are feeling like overwhelmed with getting their PPR, then, as you said, you sit down with plenty of Equity Mates listeners and work through these strategies so that over time they will get to that goal, but at the same time feel like they're not missing out on being in the market. I think that's the main thing.
It's very, very unlikely, especially if you're in your 20s or your 30s, especially if you've never owned property before, it's very unlikely you're ever going to, for now, you're going to be able to directly buy what your dream primary residence is.
Absolutely.
You have to leverage to that point, and whether it's leveraging a portfolio, whatever it is, but normally you have to leverage a portfolio to be able to access something that's actually outside your price point.
Yeah.
But the cool thing is, again, we talk about that $5 million asset. If you go and buy that with a $3-4 million deposit and have a very small debt against it, it's very manageable and you can see the way that thing can scale.
Yeah.
You can't go and buy that directly, or if you did, the mortgage would be so ridiculous. You need to earn like we're talking a $300,000 mortgage on a property at $5 million with a $4 million loan. So you need a $1.5 million deposit for the one plus stamps, plus paying that off. You need to be making like $600,000 a year, probably more. Probably $700,000 a year to be able to actually afford that equation.
It's ridiculous.
It's you know what I mean? It's not relatable.
It's not relatable.
This strategy is 100% possible.
Yeah, love it. Well, if you've just joined us for the first time, go back and listen to one of the first episodes we did with Sam where we do break down rent vesting in more detail. And as I said at the start, Sam is working with plenty of Equity Mates listeners to help them in this space. I remember meeting a bunch of them at our live events that we've done with you, Sam, who have certainly, I mean, they've now got multi-property portfolios, which is awesome to see. Now, before we close, you are doing your Australian Property Scout Summit.
Yes.
It's back.
The Summit is back.
Yes, it's back. Tickets are on sale.
They are.
It's happening in November.
It is.
November 15th at the Star in Brisbane. I think it was a sold-out event last year.
Yeah.
And this year, tickets are on sale. I think over 2/3 have already sold out. So grab your tickets now. The APS Summit is your opportunity to hear directly from you, Sam. What are you going to cover?
Oh, man, there's so much we're actually covering on the day. So many different strategies in terms of building a large property portfolio. Pretty much everything. There's almost everything you want to see covered in an event, or almost like, let's say there was, you had to listen to 10 podcasts back to back. You might have to listen to 100 to then drill down to the 10 that will actually give you value.
Yeah.
The whole idea of this event, and it was the same as last year, is to give you actionable steps and takeaways and strategies that you can apply to your own portfolio, whether you've started or you've got nothing, or you're 3, 5, 10 properties in, whatever it is. It's to actually give you the strategies to be able to continue to either, whether it's start or grow the portfolio heading into 2026 as well. And man, I did live strategy sessions on the stage where people gave me their info and I wrote it all up, and then I told, I mapped out how I would build it from there. Man, heaps of different strategies. We did the live Q&A as well, where people from the audience could literally hit us with questions too. The really cool thing of all the, pretty much all the Equity Mates listeners that are part of APS community now as well. Almost all of them are in School of Property also, and so they actually get access to the boot camp that's on the Sunday as well. So
nice.
That's closed doors for School of Property only, but that's going to be a beautiful thing that obviously is going to be there too. But the Australian Property Scout Summit, mate, there's that much that's going to be covered off in it. Absolutely action packed, and man, I'm really looking forward to doing it again.
Love it. We'll put a link in the show notes for tickets. They're on sale now. That is November 15th at the Star in Brisbane. But Sam, always good to chat. We have a live event coming up with you here in Sydney and Melbourne as well. We're going to show people how you can build wealth in stocks and property. So tickets to that is also in the link below. But Sam, thank you so much.
Looking forward to it, mate. Bryce, thanks as always.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.